For joining us. Let's understand the options. Let's understand the options here, Dhirendra, for a unit holder. I mean, Franklin has done mismanagement by buying into paper where they should have not bought into, invested into, and they ignored risk, and now they have decided to shut down the schemes. What should unit holders do?
They don't have a choice, but wait for the money to come by. And I would not say mismanaged, but yes, investors did buy into, lower quality, higher yielding papers. And the unprecedented, RBI has provided for the liquidity, but that liquidity is not enough because it is not slipping down to a AA thing. This is the kind of situation. And all mutual funds, all fixed income funds are exposed to this risk. If more investors turn up, mutual funds are in, fixed income funds in India, they have been able to liquefy assets which are otherwise not liquid. It actually acts on good faith that, investors will keep coming in. It will be a very routinized, it will be, normal scheme of things that people will come, some people will redeem, some people will put money and things will get squared up. In any situation, in fact, this is not even a credit risk thing. It is basically a liquidity and a lot of investors turning up to take their money while the underlying is not liquid. This is a systemic risk and it has always prevailed. And this shows up now more often as fixed income funds have become bigger, that whenever more investors turn up to take their money as compared to putting their money, this problem faces, occurs. It surfaces.
Okay. Now, Dhirendra, is it a good idea to really shut down these schemes? Because what you are doing, Dhirendra, is that you're shutting down the schemes when the credit crunch is at its peak. If in a year from now, 18 months from now, if the economy heals, if there is a little bit of government intervention, some of the illiquid paper could actually become liquid. So is it a sensible idea to, unwind a scheme when the credit crisis is at its peak?
They didn't have a choice. When you look at the alternative that a fund company has, and they have a set of securities, they are AA, and the market has completely dried up. Today, they are getting more redemptions than they were getting, than any inflow. There is absolutely no inflow, and they are only getting redemptions. They have 6 funds, and all these 6 funds have actually faced some kind of, if you look at the largest fund, Franklin India Ultra Short-Term Bond Fund, it has one segregated portfolio. 3 of the funds being wound up have 3 segregated portfolios. 2 of the schemes have actually 2 segregated portfolios. So if you look at it, investors are scared. This is actually scare and fear rather than a credit issue, because the underlying assets, most of it, at most, I think of this 30,000 crore, if at all, as of now, they are all AA. AA in the market right now is being looked upon as default, which may not be true, which is not the normal scheme of things. Right now, there is not even liquidity. People are not even willing to buy. If you look at, Tata Power's bonds, they are yielding 9.5%, and today we have the highest differential yield. People think that it is, debt is untouchable. Fixed income is untouchable. These are the extraordinary times when when Reserve Bank has to really intervene more actively. They don't have to just make policies. They have to make sure that it is actually getting transmitted. Just devising, academic policies which does not reach the market, because this, I'm just thinking that 30,000 crore worth of these portfolios, the worst case scenario will be, we'll have 5%, 10% default or, some credit issue happening. But as a result of this disruption, it can actually translate into, permeating into the whole system. Today, investors will be asking questions. In fact, in this scheme of thing, I think what they have done was looking like a more prudent option, because they have already exhausted the 20% borrowing limit which they could have availed. Today, they are trying to liquidate assets which will translate into substantial losses or substantial drawdown. And as and when they have actually given a frequency that as and when they are able to realize the money, which will happen in due course, because fixed income securities, they are not for perpetuity. there will be interest payment, there will be interest repayment. There are more, and all of it is double A. A good part of the portfolio is double A plus and double A. And which I was saying that, it has been looked upon as if it is default. The kind of risk aversion which we see and the one-way street where people are turning up just to take their money back, I don't know to do what, but, it's quite understandable. So this is the time where, unless you have a letter of last resort or somebody to...
So, closing comments before we hit a break. What should the AMC do in this case? I mean, they also have a fiduciary responsibility. I understand that mutual funds are a complete pass-through mechanism where you share your gains and the investors have to digest the losses. One. And second, Dhirendra, it's not for the first time. After the LNFS crisis, and given that, some of the funds have bought into the papers of Diwan Housing and other companies, this really exposes this whole perception which investors have and the way debt funds are being sold, that debt funds are safe. In fact, debt funds and select schemes have turned out to be more risky than a lot of equity schemes also now. I mean, that's an eye-opener, I guess, for all of us who thought that debt is safe. You may less return in debt, but your money is safe.
Supposed to be. And in most cases it is. If you look at the scale of things. Extraordinary times, the lack of safety that, if liquid funds, we expect that they will always be giving positive return. At a certain point, you see a negative return of a very small magnitude. But that is not the expectation. So there is a mismatch of expectation and what it turns out to be. And now risk is visiting more often.
Dhirendra, appreciate your time. Thank you for joining us. Let's take a break with the news that